trader. All right, let's jump into intraday profiles, and I want to take a moment. Let's go through these different diagrams. So ICT intraday profiles are very good diagrams. They are like market profiles for how you can interpret the day and the week. So these are found in core content month 8. And I want to share my own thoughts on how these have been successful for me and how they've also caused me to delve deeper into price. So ICT as a entire school of trading is all about liquidity. Where is liquidity? The inefficiencies, the stops, a lot of what his core principles are on will revolve around the idea of liquidity. The market will seek inefficiencies, imbalances, or stops. And so these diagrams were one of his ways to articulate or define the way that liquidity is created and used throughout a period of time. So this was in month 8, and this diagram is showing a timestamp from 2 p.m. the previous day, 8 p.m. which triggers your Asia, midnight, which is a classic midnight open concept, and then it just jumps straight ahead to noon New York time. So there are setups in here within the London time frame and then New York. So across the bottom of this table, there's an, call it the x-axis. You see the London open, New York open, and LC for London close, which goes into noon New York Eastern Standard Time. Now, when this was taught, month 8, the focus wasn't at the time strictly indices. There was a lot of Forex in ICT's content, but the principle of liquidity is the same. So pros and cons about this diagram, this template. It is an excellent way to think about liquidity. Timing is a little bit vague because the sessions at the bottom, London Open, New York Open, they're not actually that close together. If you think about how London has been defined as 2 to 5, and then New York Open kicks off at 9:30, but we've got the 8:30 news embargo lift. That's still 5 o'clock until 8:30, and if you're using a 15-minute chart, that's a lot of candles. Not so easily described by this diagram here. That small space is not really that small space. And herein lies the biggest challenge I found with using these intraday profiles or weekly profiles, is that they're so deceptively simple that they can lead to confusion. So my journal entry for today is going through how to look at these intraday profiles, because they genuinely are excellent resources to understand liquidity in the market. But we also need to understand that they are simply rudimentary diagrams, and there's a lot more understanding that needs to be sought to use them effectively. Normal protraction is like what we're looking at here, where price will run in one direction or the other and then make its move, or the real move, in New York. So when we've got this London protraction, it's not technically always happening literally in that London 2 to 5 window. There is this in-between time, and what I've done is I've split this diagram to better overemphasize this idea that these moves are happening in a not as much of an immediate methodology, but the more you understand the breakdown of different timings, you'll see that this move happens slightly delayed. So, the times that we're working with, we got 2 to 5, typical London session. Then there's this gap time. No, not a gap in terms of price gap, but just this time frame from 5 o'clock to 9:30, where there's a bunch of stuff happening, and it needs to be utilized in the right way. Otherwise, you can get caught where you are trying to trade the Judas swing in the wrong direction, get shaken out, and then the real move happens in the New York session, and that's when you want to participate in this profile. So normal protraction is, ICT uses the word protraction, where price kind of pushes up. It's basically the Judas swing, and so that push up happens in that London session timing. And then we have what we will see in the examples is where that move, that stretch, that Judas swing, how best it can be used. So the other thing on this diagram on the very far left is at 2 p.m. New York time. A lot of what that one trade setup for life does is it helps to articulate which sessions are you using for which sweeps. And that can be very confusing, so why don't we just jump into some diagrams. So first things first, it's always good to have a playbook of trades. A playbook is simply repeated diagrams that help you to pinpoint your own trade, the thing that you like to work on. And so in this one, the protraction is where we will see price move higher right after this 2 to 5 London session. So blue box in every diagram is going to be London. This yellow cream is going to be New York. The red is Asia, but we're going to focus on just how price moves in between London, the blue box, and then New York. So we see London creates some sort of range. This is an upward trending range, high, low, top and bottom of the blue box. Then the in-between time, price will meander, touch the top of London, move up again, have a sell side sweep, and then have this massive push drawing in traders to think that price is going to go bullish. And then we can see in New York, price runs lower, and we keep going lower for the AM session, and then the PM session we have a reversal. Again, the idea is that we're focusing on price in between London and New York. That diagram that I showed earlier kind of puts these two sessions almost right up against each other. And so the thing that could happen is you're looking at this London session run, this bullish run, and you're potentially thinking, all right, well, I'm going to go short now, and then you get wicked out. I'm going to go short now, you get wicked out one more time, and then you think, all right, well, I might be bullish instead, but really your original thesis was right, and you want to just wait for that timing window in New York to see fair value gap, breakdown, market structure shift lower, first presentation, bearish move. Another example, we're looking at London. We're going to see the price action between London and New York. We see that Judas swing higher. Then we start to see the breakdown in New York. We get one more run up into a premium array after we've gotten this very definitive breakdown in price. And we see we have a continuous movement lower until the end of the AM session. Again, looking at London's price action, and these are examples throughout 2024, Q4 2024, where we see London's price action. We wait for that price action in between London and New York, which runs higher. Then we see in New York, price makes that market structure shift. We retrace into a premium array, and at least for the AM session, we're seeing bearish movement. Again, the intention here is to look at London, monitor the price action in the in-between time between the two major sessions, and then in the right session, not trying to trade the in-between time too aggressively, but waiting for that in-between session to catch that bearish move lower. One more time, London, we're waiting to see how price sweeps higher like a Judas swing after that 7:30 time going into 8:30, then the true timing of session in New York. Price runs lower, we retrace up into a premium array, we see another shift lower, we can catch the market entry wherever our setup will permit, understanding that we have swept the high of London, we have made a market structure shift, and now we are looking for bearish opportunities. Again, London will do whatever London does. We're monitoring how price will sweep the high of London, drawing in traders who were bullish, and then as we go into New York, then we see the bearish shift. We look for our opportunity to go bearish, and we capitalize on the AM session in New York to maintain that bearish move. So what are some things that are going on here? First and foremost, understanding that the blue is London, we want to look at the price action in between the session. We're anticipating price moving higher and then breaking lower as we get into New York. Here are some other key things that can help out. One, if we have a PM session, previous day PM session that was bearish, that's another good reason why we would want to be bearish. What that means is we have some form of liquidity or PDRA that we can use. Another good one is using things like first presentations, that first fair value gap of the week, or the fair value gap, first fair value gap of the day. We look at this specific example. But one more time, just to reiterate, we're taking these intraday profiles, we're understanding that they are excellent forms of navigating liquidity, but recognizing that there is a lot more detail behind this very rudimentary diagram. In fact, what it really has to do with is how you are conceptualizing time between sessions. You want to trade within a session. You want to avoid getting caught in between sessions unless you really know what you're doing. Understanding that there is time that exists in between sessions, we want to see what that price does, and then in the session of choice, then we act. So in an example from today, we've got our Monday range, so that's the high and low of Monday from midnight to midnight. We can see that we had a run up, then a run down, forming these engineered liquidity on these wick lows. We're looking at London, not that we're trading London, we want to trade New York, but we want to see how price utilize London. So once that 2 to 5 window is done, we're looking at that price action running higher through London, and then we're going to go down to our trading time frames of the 5 minute and the 1 minute in our session of choice. So we're going to use the 1 minute for this example. We're going to know that we have a 10 o'clock news event. Which was jolts. So we'll mark off our 10 to 10:30, allowing the news to play out. We can see London session, price creates these engineered highs. There's a return to the midnight open, which is this dotted line representing the midnight open. We're observing that price ran higher than London, and as we opened up New York, represented by this yellow shade, we have an aggressive market structure shift returning into London. Now, once we have that bearish shift, we're looking for inefficiencies, arrays, or even gaps. We get that here. We can see our first presentation for the day after the 9:30 open. Price runs into it. We start stalling at the week's first presentation. We also have this order block strengthened by that fair value gap after that market structure shift. We get this massive bearish push down. Now we're monitoring the low of Monday. So we have our midpoint of Monday, low of Monday, high of Monday, and a 10 o'clock news event. Inside that news event, we see that price works its way all the way down. Looks like it wants to go bullish, but this is in the larger schematic of being bearish. So this is just a retrace. Price closes below Monday's low. We revisit Monday's low. We have that price action move going between that 10:45 and then the very end of the AM session, 11:45, before you've got a PM continuation. So you're looking at how these market profiles can help to frame your understanding of price. And we're starting off simply using London's 2 to 5 window and then the price action after it. Are we seeing a run up as a Judah swing only to break market structure lower, confirming that we're in a London normal protraction or a bearish move in New York, at least for the AM session. All right, keep digging into profiles this year. We'll do it again.